Now that we understand supply and demand, market structure, and liquidity, and how all of those concepts are combined, the next logical step is to move into more of the advanced supply and demand zone concepts. These concepts will improve the overall probability of a supply or demand zone being respected, because at the end of the day, when we're looking at supply and demand zones, we want the highest probability that a trade will play out. We want to combine all of the factors that we've learned so far and put ourselves in the most proper way to win when we are looking at building up a trade idea. So when we're looking at supply and demand zones, one of the biggest and most fundamental components of improving the overall probability of a supply and demand zone is a break of structure. Now, this break of structure can be in the form of swing structure, substructure, or minor structure. Depending on what level of structure it breaks will improve the overall quality of that supply or demand zone. Because of course, if price breaks swing structure, it takes more power to break swing structure than it does, say, minor structure. So in theory, the probability of that supply or demand zone being respected ends up increasing overall. So if we have an uptrend, for instance, price moves to the upside, we break this previous structural high, we form a demand zone, whether that be range created demand or pivot created demand. We're looking at this demand zone. So what we can see very easily is that price has broken the previous high, and our expectation is that price would return back to that demand zone and then tap into it. We would look for our entry and it would move to the upside. And the same would be true if we were looking at something in a bearish trend where we break this previous lower low. We would be looking for a pivot created supply or a range created supply, the expectation that price would return back to the supply zone. We would look for our sell opportunities within the supply zone, and then price would continue on. But the biggest factor to consider is the fact that price has broken structure. Now, what we might also have, if we're looking at price action, is we might have something like this, where price has created a range in swing structure. We're starting to create substructure where we're creating lower lows and lower highs as we create that pullback. And then we switch to minor structure, and now we're breaking structure. Now what we can see is we have a few different points to look at. We have 3 different breaks of structure. We have break of substructure creating minor structure. This would be our change of character. We have a break of minor structure with this high here. And then we have another break of minor structure, which is also a break of the swing structure. So what this provides us is 3 different points of interest that we could be looking to buy at, as all 3 have broken various points of structure. Now, what I had said earlier is that something that breaks swing structure is going to be higher probability in terms of the overall strength that it takes to break that bit of structure. But one thing we should also take note of is where we are in the leg of price. Now, what I mean by that is if we look at the range of the swing structure and look at where the last demand zone that was created that broke swing structure, we can see that it's the very last demand zone, the very top demand zone. And while that might be a high value area to look for buy setups, more often than not, price likes to go to the extreme. And we know from the liquidity videos, what does that mean? It just means that we're going to be filling internal range of liquidity. We're going to fill a liquidity void before we move to the upside. But what we could see initially is we could get a reaction, because what we've said in many videos is that price may react off of supply and demand zones before it commits to an extreme. And what does this end up doing? It just ends up building more liquidity for price action to come down to the extreme. But at the end of the day, the main thing to take note of is that to improve the probability of a supply or demand zone would be through understanding breaks of structure. Again, it can be a break of swing structure, a break of minor structure, a break of substructure. Of course, the highest probability would be to look for demand zones that break swing structure. And then one thing that could be said through all of this bit of price action, because of course, in theory, this would be the demand zone that broke this swing structure, but the start of that move actually came from this, which is the extreme. So in theory, the push to create that move to the upside would have derived from the higher low that is forming here in this uptrend. Because if we did something like this, what we can see is this was a high, this took out the high, this created a demand zone. We've broken structure from that demand zone, price returns to the demand zone, and then once we tap into that demand zone, price then moves to the upside, breaking the newly created higher high, and the price continues moving to the upside. And then we would just wait and see where price ends up moving down to then look for another potential entry, or at least an understanding of where price is likely to continue moving to the upside. So what we'll do is we'll just look at a couple examples of supply and demand zones here on euro dollar. We're going to look at 15-minute. We might switch to 1 minute as well. But for now, we'll just start on the 15-minute and see how we get on. What we can see if we're just looking at this little bit of price action, we can see that we have a few demand zones already clearly marked out. You can see that we have swing structure right here, price ranges, and then we break that swing structure. And if I just move the chart to the right, and what we can see is because we broke swing structure, we created range, created demand. We're in an uptrend already. If I just scrunch the chart a little bit, we can see that we're in an uptrend. So we know that the expectation is that price will continue moving to the upside. We can see that price taps into this demand zone and continues moving to the upside. Now, if we add on some liquidity concepts, we can see that we're just building a bunch of liquidity just above this zone. So it improves the overall quality of this trade setup. But again, the reason why the probability increases on this particular demand zone is because this broke swing structure, and we can see it also broke some minor structure within, because of course we have some movements, especially if we're looking on, say, the 1 minute time frame, where we switch from substructure to minor structure, we break that minor structure and continue. So we have a couple different points, but where does it come down to? It comes down to essentially the origin of that break of structure, that break of swing structure, and then price continues moving to the upside. And then if we look at this next bit, again, we have swing structure. Price breaks that swing structure, continues on making higher highs and higher lows. Price returns back to this demand zone, reacts, and then continues moving to the upside. And if we're looking at it from an intraday lens, these areas are more than enough to bank percentage, to take trades, to take longs, targeting prior supply zones and targeting internal range liquidity. Now, if we look at this area, we can see that we break swing structure once again. We create a demand zone. Price returns to that demand zone and continues moving back to the upside. Now, of course, it's not always going to be a perfect world where demand zones get respected. We did discuss in this area about the variance between the 15-minute and the 4-hour, but what we can see is price breaks swing structure. We create a point of interest. If I just do that, a little demand zone, what we can see is we do get a reaction initially, but where's price ultimately going? And this is where it comes back to the combination of looking for more of the extremes of demand and supply zones. This is a little bit more complex, I'll admit, because we continue to break structure to the upside before we come down to this last untapped demand zone. But if we look at it in the lens of liquidity as well, we have liquidity. Once we start reacting off of this point of interest, we're just dropping more liquidity. We have a large liquidity void, and we have this point of interest. And if we just compare the breaks of structure as well and the momentum that's come, we can see that this is a very large range. And we know and understand that ranges are, in theory, a collection of orders that are existing in the markets, because the market is said to be at fair value. So there's a lot of orders changing hands in and around this zone, which is why price is contained in a small range. Once there's enough orders that create that imbalance, price then moves to the upside. And what we can see with this large candle is there's a lot of momentum, a lot of volume in that candle, and price then continues moving to the upside. Now, if we do look at this bit, we do have some wicks here, and what we can see is we do break some small structure, not much of a pullback to consider that a full-on 15-minute bit of structure, but it's definitely worth noting. We can see that it does create demand, price comes down to that demand. So this is valid because it breaks minor structure and continues moving to the upside. What we can see is there is a demand zone that would be resting within this wick, more than likely found on the 1 minute time frame. Price taps into that and then continues moving to the upside. Again, we break structure. We get a more clean pullback because, as we can see, this is a pretty messy pullback. It doesn't move very far in the grand scheme of things, about 9.5 pips. This one moves about almost 13, so a little bit bigger pullback. And what we can see is the move that breaks structure. If we're just comparing, again, we're comparing this break to this break. What we can see is this is a nice clean push that breaks structure, a lot of volume in this candle. A fair amount of commitment. If we see, we break it by about 5 pips, whereas this one, we break it by about 2 pips. So definitely, if we're looking at this versus this showcases that a lot more orders have come into the market versus this one down here. And as a result, what we can see is that price reacts initially and then continues falling. And then finally, the same can be said for this area. Yes, we do break structure. Yes, we do have a potential demand zone here. But what we can see is price reacts on a very low time frame, as we can see in this wick right here. If we were to look on the 1 minute time frame, we would be able to see that this is a reaction, a very small one. Price moves to the upside and then continues falling down. We test this next demand does not hold. Why? Because we have this much larger demand zone to help propel market. But we're able to use the understanding of breaks of structure to understand demand zones' likelihood of probability. And then what we can do to add just to that is just comparing the breaks of structure on previous zones when we start to get price action that's starting to do this sort of stuff. Again, this begins to create a variance on the 4 hour, where the 4 hour is still continuously trending to the upside. This is more of a pause in the market on the 4 hour, but on the 15 minute, we're starting to see a slowdown, a potential switch in trend, and then a move back to the upside, and then followed by the real 4 hour pullback. So now if we just move on to the supply zones, now that we've switched from bullish to bearish, what we can see very quickly is that price creates a low here. And at this point, this is still substructure within the swing structure on the bullish side until we actually break this low. And what we can see is we create more substructure, and then price actually breaks structure. So we have two zones that we've mapped out and been able to map out. There's actually a third one right there as well, because what we can see is this zone right here broke this low. Therefore, it is a valid supply zone. We have a nice large wick, which we'd be able to refine our zone. And then we also have this low here. This zone right here broke this low, therefore valid point of interest. And finally, this supply zone broke this low and these lows, and therefore making it a valid supply zone. Now what we can see is when we have multiple supply zones stacked with amongst each other, we have to start putting on our liquidity cap as well, just to understand what's happening from an order flow basis. But what we can see is the very first point of structure that broke arguably the swing low, but also broke some of the substructure right here in the most recent substructure before we've seen this nice move to the downside. Which again, what we should also take note of is we reacted off of this demand zones. So although we've switched from bullish to bearish, we're still reacting off of demand. Demand is still being respected. When we start to look at the higher time frame, we're starting to see that this is a 4 hour pullback. So we have no inclination that we're going to be long-term bearish, but it's something to keep in mind, especially once we start to see that this demand zone fails and we start to see supply just getting consistently respected. Then that's when we can really start to shift our bias. But in the meantime, we can start to fill in some of the void here. Whether you took longs here or not, we would be able to use these supply zones as potential targeting areas. Again, if we look at this first zone, what we can see is we do get an initial reaction, but no follow through. We get an accumulation or a range, and then price then continues moving to the upside. Where does it return to? It returns to this supply zone, this wick that breaks this structure right here, and then ultimately breaks this structure. And what we can see is this is a pretty powerful move. And what we can see is we tap in and then we start to run off. Now, of course, this leaves this one open as well. And what we can see is we do have equal highs that have been created just above the zone. So in my mind, this would be a valid zone, although I don't have it marked on. What we can see is we just tap into it. So if I just draw on a supply zone just to articulate the point, you can see that we just barely, or we can see is we just barely miss it. If I just zoom in really close, we can see that we just get into the vicinity. We don't actually tap into it, but that does provide us with the understanding or an opportunity that this trade would have been valid to look for an entry. Now, of course, if we refine it more to the wicks here, because we have more of continuation wicks right here, we get a nice tap. But if we're looking for more of that full, clearly developed pivot supply, we would have something more in this light, because what this doji represents is a large buy before the sell, which would be indicative of our pivot supply. It's also a doji on a lower time frame is a range, so this would also be considered range created supply. Again, you could also use these two wicks right here, because on a lower time frame, what this is representing is this sort of phenomenon, which is our pivot supply. But what we can see initially is we get a small reaction. All of this just becomes liquidity. We take that liquidity, we tap into this next zone, and then we start to see a true runoff. And then what we'd be doing is looking for demand zones to hold. We have this demand zone here. What did this demand zone break? It broke this small structural high, but more so this structural high, because as we can see, as price has created this push on 15-minute structure, we're starting to create substructure. We break the high, therefore we have a valid demand zone, so we'd keep our eye on that demand zone. And if we start to look at substructure just a little bit, we have this high, we have a demand zone right here, we tap into it, price continues on, and then we have a demand zone here that breaks a little bit of structure. We don't actually quite tap into it, so there will be times when price creates demand zones on a minor structure or substructure basis, then they do not get hits, and they'll be used as internal range liquidity. So this is why the concept of supply and demand and internal range liquidity and market structure in combination becomes incredibly important, because we need to use all of these tools to better understand what's happening. Of course, it's best to start looking at supply and demand zones that are present on swing structure versus minor or substructure, but we can still use them if the overall narrative and trade idea that we're developing makes sense. But we always need to run it through, is it being created for liquidity, or is it being created for reasons to actually action and follow through with? But again, what we can see is we tap into this, and what are we creating with all of these highs right here? We're creating liquidity. What we can also start to see is we're starting to create liquidity to the downside. We're starting to see that shift in momentum. We're starting to see supply being respected. Demand is also being respected. So right now price is more or less being squeezed. We've obviously seen this supply zone fail. We've seen this supply zone fail. Why is this supply zone valid? Let me just clear off all these. It's because if we look, we have this low right here. It has broken structure. But of course, like I said, we're in this range of 15-minute swing structure. Then we start to create substructure. Now we're creating minor structure. We see a minor structure break, valid point of interest or supply zone. And then what we can see is we create minor structure, we break minor structure, we create substructure, and then we start to create more minor structure and continue dropping to the downside. And what we can see if we just navigate to the left, what do we have here? We have some wicks. And what we can see is we do break structure with those wicks. It's a little bit more lower time frame again. And this is where sometimes understanding the fractal nature of the markets comes into play. Not only that though, you don't have to trade that initial reaction on more convoluted structure where it's breaking very minor structure. You can use that as a basis to then start looking for confirmations and overall trades that are in line with that. So when you're starting to see a supply zone getting respected like this one, and then you start to see something like this where price is continuously falling, we're seeing breaks of structure and supply zones being formed, whether it be pivot or range created supply and demand. What we can then do is start to look at those particular areas for potential trades. And again, what we'd be more or less looking at is once price returns to these levels, going on to the 1 minute for our entry criteria. But of course, we can also use the 15-minute to take entries. We'll cover all of the entries in the next section, but it's just something, again, to get your mind thinking. And then just looking at this in a liquidity perspective as well, what does this end up creating? A liquidity void that gets filled. We tap into a supply zone here. But all the while, what are we doing? We're creating liquidity as price continues dropping. What we can see is this demand zone gets respected once more. If I just drag this over, the reaction is not very big. We can see that price failed to take out this high. Therefore, this low would be considered targeted. What do? We move to the downside. We take the liquidity that rests below all of these equal lows. So we've taken a lot more internal range liquidity. We've reacted to our demand zone, and that's where we see that push to the upside. All the while, though, we know that we're starting to switch bearish on the 15-minute. We have a untapped or fresh supply zone that has yet to be taken. And what we can see is this is more at the extreme that broke the swing structure on the 15-minute chart. And what we can see is we've created a lot of liquidity above it. We've created a liquidity void. We have a liquidity void that filled here, liquidity void that filled. But what does this end up doing if we have multiple liquidity voids? It creates a lot more liquidity. The fact that we have this supply zone creates the understanding that this liquidity that's created is actually relevant. Now, of course, if we just had a bunch of liquidity resting, but nothing up here, then there would be no real discernible reason that this liquidity needs to be taken before any real move happens. And what we can see is then price takes the liquidity, taps into the supply zone, and then continues to the downside. And that's when we start to see price begin to shift from bullish to bearish on the 4-hour chart. We start to see daily breaks of structure, and then the trend begins to shift from bullish to bearish on the higher time frames. Now, one thing I'll do just to continue explaining things a little bit further is we're just going to look at price action in this little bit of area, look at a couple zones on the 1 minute. Why? Just because then it allows us to filter out some zones that we're looking at. It allows us to understand the lower time frame market structure. And more specifically, it just gives us a lot more examples that we can very easily run through in a little bit more quick fashion. So we'll just start in this area right here. So we can see, if we're just looking at this, we're in an uptrend. We start to break to the downside on the 1 minute chart. Of course, we are bearish on the 15 minute, and we're starting to see a move to the upside. We can see that price has created equal highs. We've broken structure. So what we can see is this point has broken structure. We've broken swing structure, and we've begun to break substructure and taken out all of the internal range liquidity. And then price has broken that structure and then continued moving to the downside. So looking at this as a valid demand zone is definitely reasonable. It makes sense, and it is entirely valid, especially if you were to refine it to, say, this wick right here using lower time frame refinements. Again, this would be more of a seconds demand zone then, or something like this. Of course, we do spike below it, which is an indication that price is more than willing to trade lower. But at this point, if we didn't have this bit of information, we're just waiting for price to react. If we're looking at this, yes, that is tradable, but more than likely, you're not really going to get a whole lot of a move out of that. But as you can see, this demand zone was valid because we broke structure. But again, this is where multi-time frame market structure really comes into play, because now we're looking at the 1 minute. We know that the 15 minute, the 4 hour, and the daily are bearish, so looking to buy is incredibly risky. If you are looking to buy in a counter trend perspective, then you need to be much more aggressive. But we'll focus more or less on the sell side of things, just because we are looking for pro trend moves. Those are the easier, or arguably easier, moves to catch, and those are the ones we should be focusing on early on in our journey, because it's easy to try and catch a falling knife or try to call a top or call a bottom, but it's a lot harder to actually trade them. And if we can shift our mindset from trying to find reversal points and trying to instead follow the trend, our trading just becomes a lot easier to manage psychologically, and it's just a lot easier to look for trades and be in trades when they're pro trend. So now if we look at this supply zone, what we can see is we have a break of structure and we have a break of swing structure. Also, we break 15-minute swing structure. So there's a lot of confluence, there's a lot of structure breaks that are as a result of this particular move, because as we can see, we go just like that and break structure. Of course, if we're looking on 15-minute swing structure, we have this entire move. And now we're just looking at areas that make sense. And if we just look at this move in general, what we can see is we break structure here, we break structure here, we break structure here. So in theory, there may be a valid supply zone in these wicks. We can see that we break structure would be from this point. We break structure here, therefore this would be a valid supply zone, and as we can see, it does get respected. And then we now have broken real structure, a lot of structure. And if we're just factoring in, this is where it comes thinking critically about the moves, as well as this move that has broken all of this structure, taking out the 15-minute swing structure, the 1 minute swing structure, and some of this minor structure. We can see that that move is a lot bigger and more powerful than all of this mess in here. So it gives us a little bit better or stronger indication that this is probably going to be a respected zone. And what we can see is the zone itself is drawn using this pivot, which is this large bullish candle. But what we can also do is we can refine it to this top wick, or we can refine it to this inside bar, or the inside bar plus the wick. This is where refinements on your own personal study will come into play. There is nothing wrong with using any of those methods that I just described when you're marking out this particular supply zone. And as you can see, regardless of the way you use it, this ends up being a valid tap into that supply zone that we could very much look for a particular trade. So just for information's sake, I'm going to use the inside bar, but also factor in this wick right there just to include that, because what you don't want is price to tap more into this where we have a supply zone on a seconds time frame, because what we know with wicks, when we start to see breaks of structure, things like that, where it creates supply zones, that more than likely this is a supply zone on a lower time frame. And as we can see, price taps into this and then continues running off. And adding on to the liquidity concepts as well, we get a strong move away, and then price has a larger void to fill. And what we can see is we also get liquidity that's created. We have these equal highs, this collection of equal highs. This is what we refer to as inducement. The inducement is the liquidity built for the purpose of tapping into particular zones, because as we can see, we created buy-side liquidity in the form of equal highs just below this supply zone. And what ends up happening, we take the liquidity, we tap into the supply zone, and then what we can see is price then continues moving to the downside. And what we can see is we break structure, we break structure, we break structure. What is all this? This is internal range liquidity that price is taking as it continues moving to the downside. So these end up being targets. And what we can see is we don't actually fully break external range liquidity. We break it just by a pip or so, and then price pulls back. What we can see is we don't get any true taps of supply, because of course if we were looking at something, we'd probably be looking at this candle right here as it broke structure, or something up here that broke structure at more of the extreme. We don't get any of that, which is fine. The markets don't necessarily have to play ball with us all the time. And then what we can see is all of this complex structure. We can start to see we get small breaks of structure, get taps in. This is again looking at more of the fractal nature of the markets, because we break structure, we come back in, we tap into a supply zone that rests within this inside bar, which would be our range created supply, and then price continues moving to the downside. We break truly this structural swing point. Now if we're looking at all this, what do we have here? We have an inside bar. This inside bar is the last point or range before the break of structure. We've broken swing structure, so it's a logical spot to look for sells, and we can draw on a supply zone. It gets a little bit messy. And what we can see there is we have that. And again, if we're just looking at what this little bit of price action represents, and even this little bit of price action, this is inducement. This is liquidity built, buy-side liquidity built just underneath the supply zone for the sole purpose of price to tap into that, take the liquidity, and then continue moving to the downside. And the beauty of this particular setup, depending on how you play it, is we break structure, we break structure. We don't actually break structure here, and we get a pullback. Where is it pulling back to? Now we have a couple different options we can use. Again, this comes down to your own refinement and understanding of supply and demand, but what we have is we have a full pivot supply, so we could use this entire range, which would allow us to capitalize on this movement, or we can use our refinement, our fractal supply and demand zone refinement, and understand that this right here is, again, the pivot supply that we could also use. So we can use the larger, more clear pivot supply, which is basically from this range low to this range high, or we can use our refined pivot supply that would be from these wicks. Again, if I was looking at stop losses, which we won't get into too much, but I would want to factor it above the supply zone just to give the trade room to breathe. But again, we'll talk about entries and things like that in the next section. So now what we can see, if we just continue on a little bit further, is price is continuously moving to the downside. What we can see is we don't really, again, have anything that's showcasing that price is tapping into necessarily. We don't really have any supply zones in here. We take out external range liquidity, and then we continue moving. We get a very small pullback, so whether we consider that structure is a whole different story. It's about 2 pips. I personally would not consider that structure. I want to see at least 5 on a 1-minute chart to consider that a pullback. And then what we can see is price then breaks to the upside. So when we're looking at our substructure, we're starting to see that price is starting to break some of these internal range liquidity. But we also know, if we're just looking at it from structural standpoint, that our 15-minute swing structure would be this entire move. So we know that price can move within this range to still remain bearish. We also know that the 4-hour and the daily are also bearish. We also know that from a 1-minute perspective, that the true move would be something like that, as this is more of a pause in the market. And more specifically, what this is indicating to me is an area of liquidity that is more than likely going to be run. This is buy-side liquidity being set up for internal range liquidity to be tapped into. And then what we can see is we do have a supply zone here. We break structure, we break structure. And what we can see, if we just run to the right, we do respect it, but we also wick a little bit higher than that particular supply zone. And what we can see is, if we just look to the left, is yes, it does react off of the supply zone that we were already looking at here, the pivot supply or this pivot supply. And what we can see very clearly is that yes, this supply zone worked for this, but then what we can see is this candle actually ended up taking out all of this internal range liquidity and tapped into it. And if we just look at this right here, we break structure. This is what actually created the extreme break of structure. And what we can see is, if we just draw it from right here, we're just above it. But if we look at the pivot, price taps into that and then continues moving to the downside. So sometimes you have to read in between the lines. You're never going to get it perfect, but this is when stop loss placement becomes so key. because if we're just looking at this bit, if we're looking at trading off that, there's absolutely nothing wrong with it, because as we can see, we do get a reaction. And if we look at this on a lower time frame, what this ends up showing us is a change of character. We're starting to see price action change from bullish to bearish, and then we start to get confirmation that we're switching back to bearish when we get that second actual break of structure. And then we'll just carry on a little bit further. I know this video is probably drawing on a little bit longer than I was initially expecting, but I just want to make sure that this is very clear. And what we can see is we do have a very small break of structure. Again, this is looking at fractal market structure. We're still trading within this 15-minute leg of price or this 1-minute leg of price. We haven't actually broken closed above this high, so therefore we are still bearish. So if we're looking at that from that perspective, this is our move, so our impulsive move. We have substructure. We're starting to break very small structure, so we're starting to shift to minor, tap back up, and then we're starting to create minor structure. We create some more substructure, and then we start to create more minor structure before we actually take out that swing structure. But as we can see, if I just zoom in just a little bit here, we have a break of structure, albeit very small and minor, and probably not something that I personally would be wanting to trade, but we have a supply zone. And what makes this a little bit stronger probability that I would be looking at, potentially looking at this supply zone, is the fact that we have inducement being created. We have buy side liquidity once again being created just underneath this supply zone. We also have sell side liquidity being created. We know we're in a bear trend, so now we're just adding in all of the components to say, you know, I know that this broke structure, but the break of structure was pretty weak, but we're super bearish. We're still following that trend. We have liquidity being dropped to the downside, so we know that at some point it's going to target this, and if price is going to continue to the downside, this is the next spot, as well as this, and then before we take out the swing low. We've broken very minor structure, like I said, and we're also creating inducement. We also have a liquidity void. Price taps in and then continues to the downside. Now, if you didn't take that initial trade, that's fine, because in my mind, this is a fairly sketchy looking supply zone in terms of basing it off of this minor break of structure. We can add on to why this zone ends up being a little bit more higher probability in the next videos, but what we can see is this would be our extra confirmation. So we've seen this one play out. We understand why it played out. And what we can see now is we've targeted the liquidity. So the next logical spot is we're going to break swing structure if we're going to remain bearish. We're seeing demand failing, so it makes sense that the next logical stop would be here. We can see that we break structure, and we continue moving to the downside. We do have a supply zone here because we broke structure. We have a supply zone here because we broke structure. But of course, we're trying to focus on extremes. We're trying to factor in liquidity. So it gives us an understanding that this extreme portion is probably the better route to be looking for a trade. But of course, if you looked at these areas, there's nothing wrong with that. It's just being able to react off of certain elements, because as we can see, we get a small change of character. We have a pivot demand. Demand holds. Where is it likely going to go if demand does hold? Well, we're going to attack internal range liquidity before we actually move into supply and continue targeting those swing lows if we're going to continue bearish. So what we can see, again, we have inducement. We even have a little bit of inducement here. All of this, again, is just internal range liquidity that's being targeted. Now I have this zone drawn using this bit of area, but what we can very easily do is draw it just like that. And as we can see, similar to the example previous, we just barely tap into that zone. So arguably if you got tapped in that trade or not is a whole different story, but it's tapping into it. And what we can see is if we just start to look at supply and demand in a slightly different way using refinements, we could use this as our zone. We can use something more like this. It really just comes down to where you refine, how much studying you've done. I cannot stress that enough. You need to put in the work in terms of supply and demand zones, understanding what works for you, what makes sense for you that you can repeatably follow. Because if you're questioning what you should be using, you haven't studied enough. But I'll give you a little bit of insight why I used this zone specifically is because this is more of a doji. We also have that continuation pivot supply price action, but more specifically because this is a doji, it gives me the insight that this is more of a range on a lower time frame, and that's somewhere or something that I should be mindful of. So this would probably be a good spot, but I'm understanding that price could react to even this wick. So it's just something that I either cover the wick, it's a pip. So even if I have my entry down here, a 2 pip stop loss or larger is not going to be a big deal. So something to keep in mind, especially if we just weigh up the risk to reward. So if we just framed up a really quick trade, just from a risk to reward perspective with a 2 pip stop loss, even just targeting the lows, we have about a 1 to 4.3, which is still a great trade. Personally, I like 1 to 5s at least on minimum, but we know that if we're going to break this swing low, chances are we're going to run below it. So a 5R would make sense. And then if we see just below, we're starting to tap into a higher time frame demand zone. So we would be able to then gauge that price is going to tap into that. But now that we're tapping into that, this might be an indication that we're going to start to see upwards momentum. And what we can see is if we just continue on just a little bit more, we break structure, we create a supply zone is respected. And what we can see is, again, we break structure, we create a supply zone here. We do have one up here as well. If I just get rid of some of my markings, but more specifically, if we're just looking at true structure, we get something like that, a real push. So we'd be able to look at something like that. What do we see? We get a reaction, but not a follow through. We don't actually break this low. Therefore, this high is more than likely going to be targeted. We target the high, create a new higher high, but we haven't actually broken and closed above it. And then what we see is price comes down. We sweep the liquidity, we range, and then we move to the upside, breaking structure to the upside on the 1 minute. We've reacted off of a higher time frame point of interest, and we've seen a change of character. So looking at this would be a valid demand zone. I'm not sure why that's not there anymore. There we go. So now we have a valid demand zone. We have range created demand if we use the entire range, or we could just use or refine it to pivot created demand, which would be that. See, price respects it, continues moving to the upside. And what we can see is we have a inside bar here that breaks this structure. We break structure. Ultimately, we end up breaking swing structure. If we look at the swing structure and we look at the most recent move, we can see that we have a demand zone here. More specifically, right here, it does not get respected. We have this wick right here. It doesn't get respected. We have this demand zone right here that broke this structure. We get a reaction, moves to the upside, but where do we react off of? We react off of supply right here in this inside bar. Why is that inside bar valid? Because we've broken lower time frame structure as well as structure here. We've reacted off a demand zone. So now we're playing the fight between supply and demand. Supply is respected, and then what ends up happening? Demand fails because this demand zone was unsuccessful in taking out this high. Therefore, more than likely, the low is going to be targeted. And then what we can see is we have this inside bar, which was basically responsible for the initial break of all of structure that we're seeing. Price reacts off of it. We get a fairly weak reaction. Well, as we can see, price reacts off of it. We break structure. So what we can also do is look at this wick using pivot demand concepts, using our wick refinement. We can see we break structure, we continue on, we break structure, and then price continues moving to the upside. And this is the best way to really filter your supply and demand zones, is looking for breaks of structure. If price doesn't break structure, chances are it's not going to be a high quality supply or demand zone. Chances are when you have multiple, then we need to start looking at what is being built as liquidity and what is actually causing true momentum to enter the market. Because if we look at this bit of structure, we can see that we're starting to build trendline liquidity. Once we react off of this, what do we end up building? We end up building equal lows, therefore sell side liquidity. We have a liquidity void that is needing to be filled. Most of it gets filled in that sort of respect. And then what we can see is we have this demand zone because it breaks structure. This is also at the extreme versus this. There really isn't a whole lot of liquidity. And what we can see just as price continues moving on, what do we end up doing? We drop a lot of inducement before we get the real tap and then the move off to the upside. So what I recommend doing now is hitting up your charts and start looking at the supply and demand zones that you've mapped out previously, and also map out new ones, and just apply the concept or the understanding of breaks of structure and just understand which ones work, what they didn't. And if you have instances where you have, again, multiple demand zones, for instance, in an uptrend, start comparing those demand zones amongst each other, look for momentum, use the concepts of liquidity to understand why a demand zone failed and the fact that it more than likely created internal range liquidity. This is why all of the concepts leading to this point have been delivered in the way they have been delivered, and why everything is so intertwined within itself is because it's going to take some thinking when you're looking at these supply and demand zones to truly understand what's actually happening behind the scenes. You have to compare multiple demand zones, understand where the momentum came from. Has it been created to be actually tapped into to be used for order flow, or has it been created for more or less inducement or, again, building of liquidity above a demand zone or below a supply zone? So definitely take a look at all of your supply and demand zones and apply the break of structure methodology to those zones.